Here are 3 reasons why to subscribe to Fridge Financials on YouTube. Number 1, it is free, which is the best price that you can pay for this kind of content. 2, I am completely transparent with all of my investments. And number 3, I have a variety of educational videos every single week. Now let's get on with the video. What's up, YouTube, and welcome back to another Money Making Monday. It is Fridge Financials, and in today's video, we're covering some important events coming up in the economic calendar for this week and for next week. If you're excited for today's video and you want to learn something new, just make sure you smash the thumbs up button, subscribe to the channel if you've not already done so, and turn on the bell notifications so you do not miss any other future videos. Now, in today's video, it's going to be a little bit of a shorter one. I kind of want to bring to life the idea of the economic calendar. I know people probably aren't even aware there's an economic calendar, but there is, and I've learned about it over the last couple of years. So the economic calendar is something to really keep track of if you're in the finance markets, if you're investing, if you're thinking about investing, if you're looking to buy stocks, to houses, whatever it could possibly be. So this economic calendar definitely does help. It's on Bloomberg, as you can see on my screen. And today I just want to go over a couple major things that are coming up this week, more specifically Wednesday, Thursday, and then next week on Wednesday as well. So as you can see here, this Wednesday coming up, we have what is called our CPI data that will be released. Now, the CPI data here stands for Consumer Price Index. Now, I did make a video briefly, I think it was a couple weeks ago. I'll leave it also in the video so you can go back. I made a video between CPI data and PPI data, but so you can take a look about what those mean and what they entail. But essentially, the CPI data is what is called the Consumer Price Index, and it tracks the spending of the consumers. Okay, so the idea behind it is that this helps to track to see where inflation is and where it could be possibly going. And as a result of this, you know, our federal government can watch this CPI data and say, okay, is spending going up? Is spending going down? Do I need to raise interest rates? Do I need to lower interest rates? Do we need to pause interest rates? You know, those are the major factors that the federal government always talks about. And we have to know what's going to be happening with interest rates because they're a little bit higher than usual, as a lot of you already know. So on Wednesday, our CPI data for the year over year, so they compare August of this year to August of last year, and they want to see how inflation is performing. Now, year over year, this is what the previous year was at 3.2%, and they're expecting to be 3.6%, which means that they're expecting to have an increase in spending still over a year. Now, again, that doesn't seem like it's a lot of a percent difference, but it still does make a difference because, again, it's still showing that the spending is increasing, and the federal government's job is to try to decrease spending enough to where it's more of a stable economy. So we don't go into, you know, this inflationary period that we're in right now. We don't want to have deflation. We want to crash the market. It's one of those, you know, soft landings they talk about where the Fed tries to find a balance where we can raise interest rates, but not to a point where everybody freaks out and all the market gets pulled out of the market, or all the money is pulled out of the entire market and then the market crashes. So they have a tough job. Obviously, they get paid top dollar for it. So CPI over the year is expected to go up about 0.4%. And then month over month is expected to go up 0.4% from July to August. So they're expecting these increases in CPI data, which means they're expecting to see a little bit of an increase still in spending yet again. Now, again, there could be major factors to that. I know that, you know, looking at July to August, maybe there was vacations that people were taking more of, so that increases prices and those things. What's really interesting is that they also have what's called the core CPI data. And they do, again, the month over month and the year over the year. And the core CPI data takes out certain factors like food or like energy. Those ones have a lot more of an impact on the value of CPI because they have more of a weight to them. So they take out those ones that impact a lot more of the CPI data and look at just the focus is just the core CPI. You can Google the core CPI data and figure out what's involved in there, what they take out. It is all there for you. But what's really interesting is that month over month, they're not expecting to see any increase, looking for it to be at 0.2%, just like the previous month was. So again, it seems like there's not more spending compared to before. And also year over year, looking at it for it to be down 0.4% compared to August of last year. So very interesting information that will be coming in on Wednesday about the CPI data and how it works. Just so you can get an idea as to what we're looking at here, this is the CPI data that's tracked over the last 20 years. And as you can see, it's a little bit more of like a stable CPI, maybe a little bit of a spike, maybe a little bit of a decrease. You know, right around here, August 2008, July 2008, all the way down into August 2009, we had the market recession where the housing market crisis happened and then the stock markets absolutely tanked and everything plummeted. And we had this huge drop off in the CPI data. Again, people were freaking out, so people were holding their money. People hold their money, there's not a lot of spending, so the CPI data is going to dramatically decrease. Now, it recovers and it kind of goes a little bit stable. Again, you don't really see it ever go below zero unless you have a huge economic event like over here. And again, it was about like 0.1% down, 0.2% down, nothing crazy. This one was down at, again, 2.1, which is absolutely insane. And then we have the pandemic that happened right about here, goes back down to basically zero. And then, again, what happens here is that since nobody's working, you had a lot of layoffs happening, a lot of companies were closing because of COVID, they didn't want to spread the virus and all those kind of things. You know, nobody was working, there was no money being made, nobody was spending money whatsoever. You know, they were afraid, they wanted to make sure they could pay for rent, pay for food, but they were really trying to not spend a lot of money so they could have all those savings. But once we started getting stimulus checks out, we started going back to work, we started having more money pumped in the economy. That's why this increase really starts to happen. But what ends up happening is that if you do it too fast, you get this big increase in spending. And when you have too much spending going on, that is where the inflation comes in, because everyone has this spending spree. They're spending a lot of money. And if supply chains were still having issues, they can't produce enough supply to meet the demand. And that's an issue because as a result, since the supply cannot meet the demand of people spending, as a result, they have to increase prices. Increase prices is where the inflationary values come into play. And that is why we had this huge uptake in our CPI data and a huge uptake in inflation over the last couple of years, which is why things are so high right now for prices. You go down to the store, you go to get gas, and prices are a lot higher than they were a couple of years ago. And this is part of the reason why. Now, we started seeing a little bit of a drop off, which is very, very nice. So maybe we might have hopefully hit that peak. 9.1% was absolutely insane. Again, at least in the last 20 years, that's their highest value. It's probably, I think it's the highest since like 1980. I think 1980 was maybe where it got closer to it. But you're looking around here, this is the highest it ever has. Now it's starting to come back down. Now, the Fed's job is to try to avoid this, where it comes down and then it really comes down. They're trying to make a soft landing where it slowly starts to kind of like bounce back down to that zero, maybe that 1 or 2% for CPI data. That's their job. And that's why they're talking about interest rates and why they always talk about, do we raise rates? Do we lower rates? What do we do with them? You know, so as you can see here, we're looking at the 30-year fixed mortgage rates in the United States. And again, this is over the last at least 30 years, if not, actually it's more like 50 years. And you can see here we have a lot of economic, events. There was a huge economic event in the 1980s. I'm not quite sure what it was. There was something huge. And interest rates were as high as about 18%, actually almost 19%, which is absolutely crazy. Interest rates come back down very slowly. You get the pandemic right here. And again, what happens, and I'll zoom in to kind of show you more of a visual. So with the pandemic happening right here, again, they lowered interest rates because they wanted to get money back into the economy. People are more likely to borrow money or to, get a mortgage or to get a personal loan. People are more likely to borrow money when interest rates are super low because they have to pay low interest on it, which means they're not paying much more for the loan they're getting, right? So as nobody was working, there was nobody paying a lot of money, they started lowering the rates a lot so that way they can try to get money back into the economy so that people can start loaning money out again, people can start taking out loans and can pay for them and everything else. But again, as soon as people started opening back up and working, that's when you start to see the inflation go up in value. And what the Fed does is they counteract inflation by raising rates. When you raise interest rates, people are less likely to get loans for money. And again, they're more likely to hold their money and not take out loans for houses or for student loans or for personal loans or credit cards or whatever. So as a result of that, what they do, they're trying to pull inflation back down by raising interest rates. So that's one thing to keep track of. And again, the CPI data is coming out on Wednesday. There's also another important calendar event the day after, which is called your PPI data. PPI data focuses on the producer price index. The producer price index focuses on how the producers are paying for goods and, products and materials to create their products, like cars or to get food or, anything else you could think of, clothing, for example. Anything else you could think of that they need materials to make for you, this PPI data tracks how that works. And just like they had CPI core data, those have PPI data core data as well. Again, I'm not quite sure what they take out of that one, but it is something to really keep track of to see what they take out because they take out those like more volatile indicators that might throw off the data a little bit. So our PPI data month over month is looking to go up a tiny bit, again, about 0.1%. So nothing too crazy. When you see like 0.3 from the previous and like 0.8, it's like, wow, what happened there? PPI year over year, 0.8% to 1.2%. So they're expecting the producers to have spent about 0.4% more on their materials and products from last year to this year, which again is a little bit of an increase. So, maybe they're paying more. And again, if producers are paying for more, they have to raise prices as a result to counteract it, which is why inflation is still existing, right? But you look at the core one as well. The core ones are expecting to show a decrease month over month and year over year, which is really interesting. Again, just like the CPI data, the PPI data is following that as well. And again, as you can see, this is your PPI data from all commodities across the last 5 years. Again, it's a steady, it's nothing crazy. They're like average prices they're paying for their materials and services. COVID shuts everything down, so they're paying a lot less, of course, but also they're not making as much because a lot of people aren't working. And then again, as spending goes up, then again, the producers have to pay more for materials. You had supply chain issues, you had all those different factors that make them raise the prices of their products. And again, raising the price of products means a raise in interest rate, or a raise in inflation values, because people have to pay more for them and they're spending more. So they all kind of work together, which is something just to keep in mind about for this data coming out on Thursday. Now, the last important economic event coming in next week is, let me show you down at the bottom here. The last one is the Fed interest rate decision, which is next Wednesday. So depending on what CPI and PPI data are showing the federal government, is going to help. And again, it's not like those two are the end all be all, but it's going to really give a direction as to where the rates might go. If our CPI data comes in lower and the spending is showing cooling off than expected, great. CNM PPI showing off it's cooling, great. You might see a Fed pause of the rates here. You might see the rates still be at that 7.12% that they have for the mortgage. You might see this be the same value still. Now, if the values are higher than expected and they are increasing more than expected, you're probably going to see an interest rate again be hiked up. They might raise the interest rates again, another 0.5%, 0.25%. You might see the interest rates go up even more because, again, they're saying, wow, inflation is not cooling off. We have to keep hammering interest rates to bring things back down to reality. That's the exact same thing that happened back in 1980. They really are trying to combat inflation here, so they started to really raise rates to bring it back down to try to combat inflation, which was insane in the 80s. So, that's again what the Fed is looking at doing. That's why there's a big meeting on Wednesday the 20th. So keep that in mind. Again, set your calendars if you want to. I've started to really focus on these calendars to look at some things that are important for my portfolio and my investments. And the CPI and the PPI data are coming in on Wednesday and Thursday. So you might see a little bit of a rally before then. You might see a little bit of a sell-off because people are nervous. It all depends as to what the market wants to do in reaction to it. So keep an eye on it, look for buying opportunities, and see what possibly happens as a result. So that is it for today's video. I hope you found it educational. Again, if you have any questions or comments, please make sure that you drop them down in the comment section below, because again, I'll be more than happy to answer any questions you possibly might have on these topics. Again, make sure that you've made this far in the video to smash the thumbs up button and subscribe to the channel if you have not already done so. And I will see you guys in the next video, whether that's going to be Wednesday or Friday. I don't really know yet because the work schedule is kind of all over the place. So if not Wednesday, definitely on Friday. So stay tuned for that one. Always all have a great rest of your day and set your calendars for these events. Take care, everybody.